This video is a review of the liquidation process. A partnership liquidation occurs when a partnership closes its business for good. The partnership assets are sold. Any gains and losses from those assets are allocated to the partners. All the liabilities are paid off, and then the remaining cash and assets are distributed to the partners. Once the business is closed, the partnership closes all its temporary accounts. Therefore, all expenses, revenues, and drawing will have a zero balance. The only accounts that will be left on the books are, as you can see here, assets, liabilities, and the partnership equity accounts. Let's look at the example. After many years of operations, the partnership is to be liquidated. After closing entries, the following accounts remain. So remember, the first step in the liquidation process is to sell all your non-cash assets. So here we have inventory and other assets as our non-cash assets, and these are sold for $370,000. Notice that inventory has a debit balance of $120,000 and other assets has a debit balance of $220,000. So let's look at the journal entry for the sale of these assets. Okay, we received $370,000 for the non-cash assets, so we will debit cash for $370,000. We have to remove the assets we sold at their cost. So inventory had a debit balance of $120,000, so we are going to credit inventory for $120,000 to zero it on the books. Other assets had a balance of $220,000, so we're going to credit other assets for $220,000 to zero out that account. Now if you look, we have a gain on this transaction. The inventory and other assets altogether total $340,000. We received $370,000 for the assets. That means we have a $30,000 gain that we need to divide among the partners. So what we're going to do is allocate the gain among the three partners. There were three partners in that partnership, and gains and losses will be shared equally. So if we take the $30,000 and divide it by the three partners, each one will have a credit of $10,000 added to their accounts. Okay, now let's look at the new account balances after that journal entry. If you will recall, we had $10,000 in cash and we just sold our assets for $370,000. So our cash has gone up to $380,000. Inventory and other assets are gone, they're sold, so they have a zero balance now. We took those off the books with those credits. Okay, so all we have left are the liabilities and the new partnership balances. Donna Morning had $95,000 and we just gave her another $10,000 credit, so her balance is $105,000. Knight had $120,000 and we added $10,000 to his balance to give us $130,000. And then Noon had a $55,000 balance and we just added $10,000 to give her a $65,000 credit balance. The next step in the liquidation process is to pay off the liabilities. This partnership owes $80,000 in liabilities, so we're simply going to pay that off. That's a pretty simple journal entry. We're going to debit our liabilities account. It might be accounts payable, It might be several different liabilities, but anyway, they're debited to bring them to a zero balance. And then we're going to credit cash because we have to pay off those liabilities. So let's look at our balances after this transaction. Okay, cash was decreased by $80,000, so its balance is down to $300,000. We still have no assets because we sold those, and then we paid off our liabilities, so now it has a zero balance. Paying off your liabilities has no effect on your partner capital balances, so they will not have changed. Okay, the third step in the liquidation process is to distribute the remaining cash to the partners according to their partnership balance. So Donna Morning is entitled to $105,000 of the $300,000. Night gets $130,000, and Noon gets $65,000. Remember, when you're distributing the cash, do not divide it equally like we did the gains earlier. The partner is entitled to whatever their final balance is in the partnership. So let's take a look at that journal entry. We debit each partner's capital account for the balance that was there. That will bring the partnership accounts to zero. Likewise, the credit to cash here for $300,000 will bring the cash account to zero. So when we look back at our balances, all our partnership balances now are zero, and the partnership has been liquidated. So now let's take another look at another scenario. Let's say that the assets were sold for only $295,000 instead of the $370,000 that we saw in the other example. Okay, so inventory and other assets have the same balance as before. Together they total $340,000. So if we look over here, we're going to debit cash for the $295,000 we received. We will credit our inventory for its balance to zero it out. We will credit other assets for $220,000 to zero those out. So we have a total in assets of $340,000 that we sold for only $295,000. That means we have a loss on the sale of these assets, and that loss, just like the gain earlier, has to be distributed to the three partners equally. So the difference is $45,000. That's our loss. So if we divide that by 3, each partner's capital account is decreased for the loss. To decrease a capital account, remember, you debit it. So each partnership capital account is decreased by $15,000. So when we look over at our new balances, our cash has gone up from $10,000 to $305,000. Our assets are zero because we sold them. We still have our liability. And now look at all our partner capital accounts. They've all decreased for the loss. Remember, Morning had $95,000 and we reduced her capital by $15,000. Now she has $80,000. Night had $120,000. We reduced it by $15,000, so now he's down to $105,000. And then Noon had $55,000, which was decreased by $15,000. So her capital is now $40,000. So the next step in the liquidation process is to pay off the liabilities. Once again, we have the $80,000 in liabilities. That journal entry will not change. We credit cash for the payment and debit liabilities to zero those out. Okay, so cash has changed. It was decreased by $80,000. The liability account is now zero, So all we have left is the one asset cash and then the partner capital accounts. So remember, we are going to now distribute the cash according to the partnership balances. Okay, now we'll pay all the partners off everything that they're entitled to. We'll credit cash for the cash balance of $225,000, and then Morning is entitled to $80,000 of that cash because that is her capital balance. Night gets $105,000, and then Noon gets $40,000, and all their capital accounts are debited to bring them down to zero. So now the partnership is once again liquidated.